Hey traders, this is Ron Haight. Happy Tuesday. Hope you guys are having a great day. As always, everything in this presentation is for educational purposes only. Daily chart here, the S&P 500 ETF, this spiders, this is Thinkorswim, and I have some lines on my screen, so let's just go over them. The red line, as usual, is the 20-day EMA, good for trend trading, swing trading, if you will, I think. The 50-day in orange, that is a simple moving average, but is also known as the institutional moving average. That is the big mama, the big papa. If you're a bull, you want to stay above it. If you're a bear, you want to get below it. That is what institutions pay attention to. Right now, we're sitting above both. Therefore, the outlook this week is still bullish, which is what I said in the weekend video. Now, this island reversal pattern up here is still in play. Remarkably, even after the 1,800-point drop, we never even went back up and filled the gap completely, nor have we really broken down. It's sort of digesting this move. So if I zoom out a little bit, we had this really crazy rally, right? And this was the last sort of shoot higher. This was the last hurrah for now, and now we're just chopping sideways. Bulls really aren't winning since that gap down. Bears really aren't winning. We're just going sideways, biding its time. Now we take out those highs. That invalidates the island reversal, and bulls are on course for all-time highs, at least a challenge. We get below the 50-day. That is what the institutions pay attention to. We get below there, and then all of a sudden, that's where we start saying, uh-oh, are we going here? Are we going here? Are we going here? So yes, we're bullish in the daily charts, but I would just put some caution in here because I did get a question on it. And yes, the island reversal is still in play. It did mark the top of the rally so far. Now, I also have some green lines in here. These are 2 standard deviation John Bollinger Bands, which we're going to talk about here in a little bit. So I'll come back to those in a sec. Now, here are the diamonds, the DIA, the Dow. The Dow is not as bullish, if you will, as the spiders. It hasn't rallied quite back as much. So it's lagging a little bit. It's not the end of the world. We're still above both moving averages, the 20-day in red and the 50-day in orange. Also, here's a high, here's a high, here's a high, sort of an equal high. We're really not breaking that pattern. All we know is the 50-day held on June 26th. That's a big deal. The 50-day held back on May 13th and May 14th. Therefore, we get below it, that's big news. At this stage, that's about 600 to 700 points lower in the Dow, $6-7 on the diamonds. That could easily happen in one more day because we did come off the highs today. So if we get some more selling pressure, we could be talking about, whoa, sell signals in the next video. Now, the Qs. They were interesting today. They were up quite a bit. In fact, if I pop this window open, the NQ futures, their high was 10,694. We finished at what? 10,527, basically lows of the day. So if I come in here and I look at the NQs, you can see we were up there, we came back down. It's not the end of the world. Let's switch over to the Qs again. But the point is this, we were up over 100 points on the Qs and we finished lower. The Qs here were as high as 260.88. We finished at 257.27. We finished $3. That's a big deal. So instead of being up, nearly 1%, we finished down about 0.69. But even with that move today, which could look like a little bit of an exhaustive type move, there was no bearish engulfing. There was no huge spike in volume, and 0 technical damage was done to the chart, even with an exhaustive type feeling of a move. Therefore, the Qs are still strongly bullish. Now, I brought in the 2 standard deviation Bollinger Bands, which are these green lines. When a stock or an ETF get outside of it, pretty much if that entire candle gets outside of it, it usually marks a very short-term top at the very least. Sometimes it could be the top, you never know. But usually short-term top, because this is a daily chart, you're looking at a couple days. If this was a weekly chart and that candle is completely outside of it on a weekly basis, then you're looking at maybe a multi-week move lower. So a daily chart, just look what happens. We get outside the upper 2 standard deviation Bollinger Band here. Immediately we have a 2-day pullback. We get outside of it here just a little bit. 1-day pullback sideways. Then we get out of it here. That's almost a full candle outside, and what happens? Down day. So if I was playing very short-term trading, whether it's an ETF or a stock, when you see these past patterns playing out, that tells you, okay, if we get outside the Bollinger Band, no, I don't want to go long with a new short-term bullish position. In fact, if I want to be very aggressive, I might even consider a short-term bearish trade. Funny how that works. There was immediate pullbacks each time. You don't know how long the pullback is going to last in terms of days, time frame, nor do you know what the percentage pullback is going to be. All the Bollinger Bands do is tell you that when you get back inside the bands, that move, meaning this was overbought, If it was down here, it's oversold. That exuberance has been resolved. So it doesn't need to get here, 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 or here, back inside the bands, just back inside. And this is considered the overbought, is now gone. Now this comes in handy if we look at something like an Amazon. Now with Amazon, looking back here just a little bit, there's a couple things to consider when you're using the Bollinger Bands. If the Bollinger Bands get tight, it's sort of like a soda bottle. You shake the bottle with your thumb over it, eventually the pressure is going to break and it's going to go flying, right? So when the bands get tight, there can be a pop. But when the bands are already spreading and you start printing candle after candle outside the Bollinger Bands, every day that happens, the likelihood is more and more of a sideways to down move, something to get back inside the band. So let's go over here. Here is earnings back in January. The bands got tight. And what does tight mean? Relatively tight based on the stock's own performance. So if I would go back here, look at a 2-year daily chart, we would say, oh, look, bands get tight, pop, bands get tight, pop. That's what we're really looking for, just that. So let's go back, and here's a 1-year chart. Now let's do 6 months. That's plenty of time. Here we go. Bands get tight. Well, wouldn't you know, it's earnings. Looking for the latest update from the company. Stock gaps higher, and look what happens. Let's zoom in here. Outside the band, even on a fixed news report, which can often cause those massive breaches, breaks of Bollinger Bands, what happens? Sideways, sideways, sideways. The moment that overbought condition was resolved, up we go. You don't know how far, how long, but isn't that funny? The likelihood of a continued move higher was no longer with you. 90% plus of the data is going to be within these bands. Therefore, when you get outside those bands with a full candle, you are trading against the odds. Would you rather have a 90% chance of success or less than a 10% chance of success? Think of it that way. You're out here, you're in the less than 10 percentile. Therefore, why would you want to go long? I'd rather wait for it to come in and then see if it's going to run. Okay, so that was there. Let's zoom out. Then the stock came down. We never really got full candles outside, but well, here we sort of did, and it bounced for 3 days. Then we go sideways, right? Then it starts to pop. Well, the bands got sort of tight a little bit. We began to pop, and every single day we get outside these bands, you're playing with worse odds each and every time. Eventually, what happens? A whole month of consolidation. So when you see stocks that go bonkers through the upper Bollinger Band, for example, history says if you keep buying on the end of the days when we're outside those bands, you're not going to do well if it's a short-term trade. And then we go sideways. Look how tight the bands are getting. Now the bands are starting to widen. Look over here. Here we popped up one. The next day, completely outside the Bollinger Band, what happened? 2-day pullback. Now, Amazon still went almost $500. Actually, it did go $500 higher. But if you were playing a 1 or 2 or 3 day trade, you would have been burned, right? You can almost watch this for a pullback. Oh, we're outside the bands. Guess what? I might want to go long Amazon. I'm going to wait for a day or two, see if it pulls back, and buy it on the cheap. And from that close, which was 26.47, the next close was 25.45. You could have bought Amazon $100 cheaper 2 days later. Wouldn't that be cool? All right, then we start going higher. We come back and test the 20-day, and now look. Pretty much that candle from Monday was completely outside the upper Bollinger Band, and magically today we get a pullback. Now we're sort of right on the band. I have a sneaky feeling we're going to get one more down day. I think history might play out here. Maybe get 1 or 2 more down days. But the moment it comes inside that Bollinger Band, overbought, has been digested, and now it can just go back and do what it wants if it wants to keep soaring. Now I will say this with Amazon. I was reading something on Zero Hedge. They're calling it the Amazon killer. Walmart was out with their version, or they're coming out with their version of Prime. And Walmart was up huge. Their volume today, I mean, what is their average volume? 13, 14, 15, let's say 10 to 12 million shares. Today, the volume was 30. Now that's huge. Closing at the highs of the day, at this point, I would probably say the high of that bearish engulfing candle right there around 132 and up to 133 of the targets. When you get that kind of volume, it's a big deal. There should be some follow through. Now let's use that with the Bollinger Bands again. Hey, we're outside that Bollinger Band. This is a big deal. Yes, but this stock has essentially gone nowhere practically since the end of April. If anything, just barely slightly down. So when this happens, it is likely, I can't say likely with a percentage because, quote, you are now betting against, the odds are against the rise continuing at a rapid rate. But keep this in mind though. When you go sideways, like it has for so long, we are likely to see another 1 or 2 day pop before it then begins to pause again. So here you can actually expect another update or two. Pause and maybe then a rip. So we can keep an eye on this one. All right, how about Tesla? Now Tesla is its own animal, very, very volatile. But even though it's this volatile and it almost acts like a biotech stock, even though I hate trading biotech stocks, I could still trade the stock, but maybe just use smaller amounts of capital, right? But isn't it funny, even on something like Tesla that seemingly has lost its mind again at $1,400, look at the Bollinger Bands. We get a full candle outside over here in February. What happens? Now the stock was around what, 888 or something? We went right back down to 7 something, almost $200 lower. And then we went right back up and set new highs. We come down, we're not outside. Oh, look at here. Actually, here we had a break of the, look at that, a break of the Bollinger Band, but it was really tight, so that's sort of not as valuable. Then we get a break here, and then a full candle outside the Bollinger Band. What happens? Immediate till the 2-day pullback. There you go from 1,025 was the close, and the lows here were what, 900? That was another 100-point plus pullback. Now you're seeing 1, 2, 3 candles outside the upper Bollinger Band. This thing has gotten way ahead of itself. We're likely to see a similar situation where we get 1 or 2-day pullback, gets inside the bands, and then maybe it wants to keep going higher. But there's no way I would chase a stock 3 straight days outside its upper Bollinger Band based on history and how the Bollinger Bands work. You are now betting against the house. You know, you're not going to go into a casino and typically win if you're playing slots. The house has the advantage. They have the advantage in, frankly, every game, it seems. But that's what this would be an analogy to. So just beware of that. Now, how about eBay? Sort of another stock like this. Here was a big spike up, and what happened? Outside the Bollinger Bands, down we go for 2 days, we go right back up. That's it. That was it. You outside the bands, no way I could be bullish, at least for a couple days. We pull back, we're inside the bands. Overbought is gone. We come back up, we come lower, and now what's happening? 1, 2, 3 days outside the bands. Same thing like Tesla. No way I would go long for a short-term trade. I'm not talking about the idea down the line eBay can't be a $100 stock or Tesla a $3,000 stock. But for the very short term, the odds are now against you, also here with eBay. What I would also consider using eBay as an example, which can go for Tesla and can go for Amazon or even Apple. I get asked a lot, well, when stocks are this crazy bullish, what are some exit strategies that we could potentially consider, of course, from an educational perspective? Let's say I had 3 long calls on eBay as an example. When I would get an explosion outside the upper Bollinger Band, maybe that's where I pull 1 long call off, use the red line as the final exit, and that's where I would get rid of the last 2. So if I was trading it here again, we're outside the upper Bollinger Bands, I would sell 1 long call back, I keep 2 until we get below the red. Now, that brings in a different situation where what if the red and the orange are relatively close together? Because sometimes the red line works amazingly well, like we've shown on some stocks, but maybe other stocks it doesn't. What do we do then? Here's what I would do. Something to consider and practice on paper. 3 long calls. Maybe I sell 1 when we pierce the Bollinger Band. When we come back and hit the red line and bounce, I can buy it back and go 3 long again. Another scenario. Outside the Bollinger Band, I sell 1 just because you're playing the odds. Get out because there's probably going to be reversal. We get below the red, I close the second. We get below the orange, I close the third. We have to keep in mind, though, that orange could be so far away. Here the stock's at 57, the orange is at 45. That's over 20% lower. That's huge. Depending what the value of that long call would be, or even if I was trading stock, that could be a huge hit. Different ways to approach it. I love using the red line. I would consider practicing with that. You know, you get below that, you just stop yourself out. But if the red is really choppy, then maybe even consider an orange. So hopefully that's helpful. I get asked those types of questions from time to time. So we did Walmart, Apple. It's still doing fine. It's above its red line too, and the same approach goes there. Look, here was Apple, complete candle outside the Bollinger Band, and boom, 1-day pullback. We went from a close of what, 352, got down to 332, 20-point difference. Not bad. Now, American Express. Although it's not your typical bank stock, it is in the finance sector, and we just lost the 50-day here. This is very interesting. Its next support level is going to be that bullish engulfing down here, $77. That's what, 12 bucks lower, 15% lower on American Express. Check out WYNN. WYNN was staying on top of the orange line, and we've talked about this before. I'm hearing just different reports from Vegas that things are not going well. People are not coming back in droves. I don't want to go down that rabbit hole of why. It's sort of like, duh, government. You make it too hard, people aren't going to come back. But that's a whole nother conversation. But purely from a stock perspective, you break out, you back test, you break. It hasn't broken the 50-day since all the way back up here. And then look what happened. We break the 50-day, we come up, now we can't even get above the red line, the 20-day, and now we're rolling over. So it was once support, is resistance, and we can't even get up there. Very, very interesting. Here is Las Vegas Sands. It broke the 50-day here, came back up, hit it Monday, and now we're rolling over. Las Vegas Sands is a lot more choppy. There is some support at 43-ish, but then you would go maybe 41 and then 37. And check out some of these hotel stocks like Marriott. Once we broke the 50-day back on 624, now we've come back up and we've hit it 1, 2, 3. We cannot get through it. So if I was trading something like Marriott, what I would want to be aware of, if I'm a bear, this looks great. You break it, you're bouncing into it, and you're getting rejected. The only thing better is if volume would have been high again today, showing that they were quickly coming in to sell. But there's also a nice theoretical stop here. We get above the 20-day EMA, the 50-day SMA in orange. The 50-day SMA in orange, it was support here, support here, support here, support here. Then it was resistance, 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 resistance. You get above that, the bearish trade is dead if it's a short-term trade. That's how I would treat it. So right now, this could be a bearish trade idea, but above the orange line, dead duck. And let's take a look at Hilton. Similar situation. Once it broke the 50-day, let's zoom in. We cannot stay above it. We get above it, but we can't close above it. Again, I would consider that as being a relatively tight stop above the orange line. That trade is over. How about Hyatt? Now, fundamentally, Hyatt is better positioned than Marriott or Hilton from the research that I've done. But once they lost the 50-day back here on 619, now we just hit it on Monday and we're rolling over. Again, volume's not rising. If volume was rising, this would be a beautiful thing. It's not, but look, we gapped lower, closed the lows of the day. That's not a good sign. So 50-day here would be a stop as well. And then take something like Starbucks. We zoom in. They lost the 50-day here. They're trying to get back above, and they did. This one is more choppy. I bring this in to show you that nothing's perfect. But if I wanted to try to be bearish, even on something here where it's not perfect, I would still use the 50-day as a trailing stop. Because if you get above the 20 and the 50, you're back above both moving averages, and then you start looking at a gap fill for a potential target. So it's not perfect all the time, but what I'm seeing here is big volume spike, break of the 50-day, not a good sign. As the stock rallies, volume pulls back, lack of conviction. We start rolling over, and all of a sudden the red bars are bigger than the green bars. So even though it's not perfect technical analysis with the 20 and the 50, here, the volume is more telling. Right now, Starbucks is definitely going through some weakness. And if I wanted to be, whether it's a bear call spread or just outright bearish on Starbucks, where would my stop be? Above the orange line. I would need something on that chart, on that map to get out at, and that's what I would consider using. Okay, so long video, didn't expect it to go that far. Bulls have the edge still this week, but I still think there's some caution. Maybe today was a bit of an exhaustion day in the Nasdaq with us coming off those highs. Only time will tell. Earnings season is T-minus a week away, and that'll give us the latest update on how companies are doing. So wish you guys a great rest of the week. If the market keeps moving around, I'll do a video every night if we get big moves. Otherwise, the next chance of a video would probably be on Thursday. If not, I'll see you in the weekend video. So again, take good care, guys. See you later.